Welcome back. In the last video in this lesson, we're going to think about budgeting. Budgeting is how we take all of this financial accounting, all those expenses, the revenue, the assets, and use them to make projections about the future. When budgeting, we usually need to predict next year's costs, and we almost always work with percent increases, which is called forecasting our budget. Managers often receive estimated increases from finance or industry trends, and then their job is to calculate what those increases will actually mean in dollars. And those increases are typically given as a percent. So let's just get right to it and try a practice problem. If a company is spending $15,000 on food costs and food costs are expected to increase by 3% next year, how will we figure out how much we need to budget for foods? Well, this is just a really straightforward application of percents. We need to remember what 3% means. And of course, per cent means of 100. So 3% is 3 over 100 or 0.03. So if our food budget is $15,000 and it's expected to go up by 3%, we multiply those together and we find that the change in food cost is $450 on top of the $15,000 that we're already spending. So next year we would need to budget $15,450. But that's not the only way to do this problem. The percent is an increase. So we're not losing the food costs right now. 3% added to the 100% that we already have going on right now is 1.03. So we could solve this problem a little bit faster by using 1.03. That's the 100% of the value that isn't going to be lost next year, plus the additional 3%. 103% is 1.03. So if you take $15,000 and you multiply it by 1.03, that's the same as multiplying it by 0.03 and adding it to the initial $15,000. Either way, you come out with a forecasted budget of $15,450. This structure, taking a total and increasing it by a percentage, is used again and again in budget forecasting. So let's see a problem where it's applied across an entire department. This is a kind of example you'll definitely want to understand for the RD exam, and honestly, it's helpful for real-world practice too. This long-term care facility has a budget of $540,000 for this year. We see that the labor costs are $315,000, and it's expected to increase 3%, so that's 1.03. The food costs are $125,000. It's expected to increase by 4%. And the remaining operating budget costs are expected to increase by 2%. But we don't know how much those are. We're trying to figure out the projected budget for next year. So we have these different categories: labor, food, and then remaining operating budget. And they each have their own percent increase. So I'm going to build this table. I like tables. The labor is $315,000. The food is $125,000. And then we actually have to do a little bit of math here to figure out what the remaining operating budget is. If the total budget is $540,000 and we're subtracting out the labor costs of $315,000 and we're subtracting out the food costs, that leaves us with a remaining operating budget of $100,000. And we know these increases. The labor is increasing by 3%, the food is increasing by 4%, and the remaining operating budget increases by 2%. So to save me a little bit of time, I'm going to multiply by 1.03, which is the same thing as multiplying by 0.03 and then adding the initial 315,000 if that's how you'd rather do it. This just saves me a little step there. The 3% increase brings my labor budget to $324,450. The 4% increase on $125,000 takes my new total to $130,000, and my 2% increase takes my remaining operating budget to $102,000. The question asks for the projected budget for next year. So if I add all of those up, I find out that my budget will be $556,450 using these projections. The more organized you can be with these calculations, the easier it is to get the points on the RD exam. Let's try another one, looking from a different angle. And as always, I highly recommend you try it on your own and then come back to join me. We're told a cafeteria makes $850,000 every year in sales, and labor costs 33% of the income, but we don't know how much labor costs. And we anticipate that labor costs are going to rise 5% next year. We want to know how much that's going to cost for next year. But in order to know how much it costs for next year, we need to know how much labor costs right now. Make sure you have tried this problem on your own before you do it with me. I'll be here for you. So if labor costs 33% of the income, this is a straightforward percentage problem where 33% is my percent, my total outcomes is my amount of sales in total, 850,000, and we're solving for specifically the labor costs. Now, to practice this, if we're solving for our specific outcomes, we need to divide both sides by 100 to get specific outcomes on its own. And this is a percent. So we obviously take 33 and divide it by 100 to get 0.33 as a decimal percent. 0.33 is equal to my specific outcomes divided by $850,000. And if we want to get specific outcomes on its own, we have to undo this division, which means we have to multiply both sides by $850,000. And when we do that, it comes out to be $280,500 is the total labor costs, given that labor accounts for 33% of income. That's this year. That's not what this problem is asking us. It's asking what the labor cost will be for next year. And there's two ways to do these percent increase problems. Let's do it both ways. I personally prefer to solve these problems using the increase factor of 5%, multiplying it by 1.05. Multiplying it by 1 would be 100%, meaning the price is not increasing, but since it is increasing by 5%, we can multiply it by 1.05 to get our new labor cost of $294,525 is a 5% increase on labor costs from this year. Or we can plug 5% into our percent income. $280,000 is the total outcomes of labor costs, and we want to figure out what the change in labor costs will be for next year. So again, we would divide both sides by 100 and multiply by 280,000, and we come out to 14,025. That's the increase in cost for labor on top of the initial 280,500. So when you add those together, you still get 294,525. Either way, same answer. So use whichever one feels most natural to you. Just remember that 1.05 represents a full 105%, the original value plus the 5% increase. Okay, so now we're going to shift into our last budgeting tool for this lesson that helps us evaluate investments, and that's called the payback period. The payback period tells us how long it takes for our investment to pay itself back. And we calculate it by using yet another decimal percent equation, another one of those per equations. The payback period is equal to the amount that the investment costs divided by the revenue generated by that investment. This is another ratio, another equivalent statement. It tells us how many units of time it takes to break even and pay itself back. The shorter the payback period, the more appealing the investment, especially when you're working with a fixed budget or aiming for a fast return. So let's walk through a full example. And before we get started, as always, I encourage you to pause the video and try the problem on your own. Then come back and we'll work through it together. All right, here's the situation. A restaurant wants to upgrade its industrial washer. The dishwasher is going to cost us $10,500 and it's going to cost us $500 to install. We then need to train the staff to use the dishwasher, and that's going to take us 5 labor hours at $15 an hour so that our staff knows how to use this new fancy dishwasher. The manager anticipates that the industrial dishwasher will save then 5 labor hours every single week because it's bigger or it's faster or it doesn't take as much to run it. And so they want to know how long it will take for that investment to pay itself back, the payback period. So let's start by calculating our total investment. Because the payback period, we need to figure out how much we're investing. Well, we're investing straight up $10,500 and our $500 installation fee. But there's also training that needs to be done. 5 labor hours at $15 per hour. So our total investment will take all of our inputs, the cost of the dishwasher itself, the cost of the install, and then this right here is the cost of the training. Since we need to take 5 hours at $15 an hour, we'll figure out the cost to train, adding to those other costs. My investment amount is $11,075. That's how much it costs to get this dishwasher installed, and up and running. Then we need to look at the revenue generated by the investment. The manager expects it will save 5 labor hours per week. So we're going to look at this on the week. Our payback period unit will be week. When we calculate the revenue generated by the investment, we're saving 5 hours a week at $15 an hour. So it should be saving us $75 every single week. Now we have our two values. We have our investment amount, and then we have our revenue generated. So we can plug this into the equation for payback period. Payback period is the investment amount, $11,070, divided by the revenue generated, which is $75 a week. Notice dollars are in the top and bottom of this fraction. Dollars cancel out, and we're left with units of weeks. It's going to take 147.7 weeks for this industrial dishwasher to pay itself back. That's almost 3 years for the investment to pay itself in labor savings alone. This kind of analysis helps us make smart, data-driven decisions, not just about what to buy, but when it's worth it. So as we approach the halfway point in Module 1, make sure you're keeping up. It's recommended you keep a list of all the equations presented, that you try the practice problems a few times until you master them, and that you reach out to others, because you are not alone. Leave any questions in the comments section to make sure you're getting the support you need. And as always, I'll see you in the next one.